People think gold suddenly surges out of nowhere. One day it's ignored, quiet, boring, then suddenly everyone is talking about it. Prices explode, headlines panic, investors rush in. But what most people fail to understand is this: gold almost never moves first. The system moves first. The cracks appear first. And if you study history carefully, you begin to notice something fascinating. Before every major gold rally, the same economic and psychological patterns quietly begin emerging beneath the surface. Patterns most people ignore. Patterns governments rarely discuss openly. Patterns that signal something deeper happening inside the financial system itself. And today, many of those same patterns are beginning to appear again. So in this video, we're going to break down what usually happens right before gold surges, why these cycles repeat throughout history, and why understanding them matters far more than simply watching the price of gold itself. And if you enjoy deep economic analysis that helps you understand how the world really works, make sure to like this video, subscribe to the channel, and stay with me until the end, because the final piece of this puzzle may be the most important of all. Gold is misunderstood by most people. People think gold is simply an investment, but historically, gold has functioned as something much deeper. It acts as a mirror, a reflection of confidence, or the loss of confidence, in money, governments, and financial systems. When trust is strong, people prefer productive assets, businesses, stocks, real estate, innovation. But when trust begins weakening, behavior changes. People begin searching for something that cannot easily be printed, manipulated, or politically controlled. And that's when gold starts becoming attractive again. If you look back through history, the pattern becomes remarkably consistent. In the 1970s, inflation surged while confidence in the monetary system weakened. Gold exploded upward. During the 2008 financial crisis, trust in banks collapsed. Gold surged again. During the massive money printing era after the pandemic, investors once again feared currency debasement and inflation, and gold responded. This is why gold isn't really about optimism. It's about protection. It rises most aggressively when people begin questioning the stability of the system around them. And before those moments happen, certain warning signs usually appear first. The first major signal is almost always debt. Specifically, debt growing faster than the economy itself. This matters because debt creates future claims on money. And when too much debt accumulates, governments and central banks face impossible choices. They can allow painful deflation and economic contraction, or they can create more money to ease the burden. Historically, most systems eventually choose the second option, because politically, printing money feels less painful in the short term. But over time, that process weakens purchasing power. Currencies begin losing value slowly, then suddenly. And gold historically performs well during these transitions because, unlike paper currency, its supply cannot simply be expanded by political decision. This is one of the oldest patterns in financial history. Empires accumulate debt. Debt pressures the currency. Confidence weakens. Hard assets rise. And while most people focus only on market headlines, the deeper forces are usually already moving underneath. Another fascinating signal appears before many major gold rallies. Central banks quietly begin buying gold themselves. This is one of the most overlooked clues in the entire financial system, because central banks understand something important. Reserve assets matter most when uncertainty increases, when geopolitical tensions rise, when debt burdens grow, when trust between nations weakens. Countries begin diversifying away from dependence on a single financial system. And gold becomes attractive because, unlike fiat currency, it carries no counterparty risk. No government can print more of it overnight. No political leader can fully control it globally. That's why central bank gold accumulation often rises during periods of global uncertainty, not because governments publicly admit fear, but because their actions reveal caution beneath the surface. And historically, when institutions quietly prepare for instability, retail investors usually notice far too late. Then comes another phase, currency weakness. This is where ordinary people begin feeling pressure directly in daily life. Food costs rise, Housing becomes harder to afford. Savings lose purchasing power. People work harder, yet feel like they're standing still. And psychologically, this is extremely important because inflation doesn't simply affect economics. It affects trust. When people begin realizing their money buys less every year, confidence in the system slowly erodes. At first, most people deny it. Then they rationalize it. Then eventually, they start searching for protection. Historically, that's when interest in hard assets increases dramatically, not because gold changed, but because the currency itself changed. And this distinction matters enormously. Gold often appears to be rising in price, but in many cases, what's actually happening is currency purchasing power is declining. That's a very different perspective. Now, another important pattern begins emerging before gold surges. Financial markets become increasingly fragile. This usually happens late in economic cycles. Liquidity floods the system. Asset prices rise rapidly. Speculation increases. People become overly confident. Risk appears low. But underneath the surface, leverage quietly builds. And leverage makes systems unstable, because highly leveraged systems depend entirely on continued confidence. Once confidence weakens, the reversal can happen very quickly. And during those moments, investors begin rotating toward safety, toward liquidity, toward hard assets, toward things perceived as stores of value. This is why gold often performs best during periods of uncertainty rather than stability. It reflects fear more than excitement. And one of the most fascinating realities about financial history is this: the majority of people only become interested in gold after major moves already happen. That's human psychology. People seek safety after instability becomes obvious. But by then, large institutional capital has often already repositioned. That's why understanding cycles matters so much more than reacting emotionally to headlines. And then comes the final phase before major gold surges, the psychological shift. This is where fear spreads broadly across society. Trust in institutions weakens. Confidence in policymakers declines. Markets become volatile. People begin questioning assumptions they once considered permanent. And when uncertainty reaches that level, gold can move aggressively, not gradually, rapidly, because markets are driven by psychology just as much as economics. And psychology can shift far faster than fundamentals. This is why some of the biggest gold rallies in history appeared almost explosive. Not because gold suddenly became valuable overnight, but because trust disappeared faster than expected. Now, does this mean gold always rises forever? No. Nothing moves in straight lines. Every cycle eventually reverses. But history repeatedly shows that before major gold surges, the warning signs often look remarkably similar. Rising debt, currency pressure, central bank accumulation, fragile markets, inflation fears, geopolitical uncertainty, and declining trust in financial systems. The important lesson is not blind fear, it's awareness, because understanding how these cycles work allows people to think more clearly during periods of uncertainty. Most people wait for headlines, but by the time the headlines arrive, much of the shift has often already happened. That's why studying history matters, because while technology changes, human behavior rarely does. And throughout history, whenever trust in money weakens, societies consistently move toward stores of value they believe can survive political and economic instability. That pattern has repeated across generations, and it may continue repeating far into the future. The real question is not whether cycles exist. The real question is whether people recognize the signals early enough to understand what they mean. If you found this analysis valuable and want more deep breakdowns on economic cycles, wealth preservation, and how the global financial system really works, make sure to like this video, subscribe to the channel, and turn on notifications so you never miss the next episode. Because in times of uncertainty, understanding the game may become more valuable than almost anything else.